Good morning, Flagship Harbor Advisors. Eric Jefferson with the core team. Happy Monday. Today is January the 31st, 2022. Just a reminder, this replay is for advisory use only. I hope everyone was able to enjoy some football over the weekend in between shoveling. I know we had a busy week last week, so we can dive right in. Very encouraging to say, here we are at the end of January. First week, we actually saw the S&P end in the green. Granted, wasn't looking that way through trading on Thursday. Took a very big update on Friday, driven by some encouraging earnings out of Apple. Buoyed the NASDAQ over 3%, bringing S&P to the green. Year-to-date performance, though, still down just around 7%. And again, a brunt of that volatility has been driven by the growth side of the equation. Large growth down double digits, over 11, versus large value down about 2.5. Again, we talk about there's a bull market somewhere, as we've mentioned. Historically, we believe for the environment today, that is in the quality space. If you look at the quality tilts, so from an implementation standpoint, across the different cap size, S&P 500 versus S&P 500 quality, latter is outperformed by about 150 basis points year to date. And the mid cap space, that's about 250, and the small cap space about 500. So again, broad market, Russell 2000 down over 12%. Small cap, high quality performed right in line with the S&P this year. That's an area we think there will be a lot of opportunity going forward. Same thing in the non-US space. Both developed, international and EM, have outperformed, down 6% and 3% respectively. But from the implementation standpoint, think about those low vol, those higher quality ETF screens. You've seen low vol outperform by an extra 150 on the international side. And EM actually positive for the year. Again, granted only up about 40 basis points, but that's a position with a lot of red out there. Good to certainly see some green. As we talk about, number one driver of stocks historically has been earnings. We're about a third of the way through earnings season this week. Again, here's from some big names: Amazon, Google, GM, Exxon. So far, despite some major misses, overall results have been modestly encouraging. Have about an 80% beat rate. Consensus for 2022 EPS has increased marginally to 224. So again, do think that is a somewhat constructive backdrop. But obviously, though, I think this is an environment going forward where it's less about owning the broad market, more about picking and choosing those specific regions, sectors, and asset classes that you want to own and those that you want to avoid. When we look at the sector breakdown, the three sector allocations in our tactical portfolios, healthcare, financials, and energy, happen to be the best three performing sectors this year. Healthcare trading right in line with the S&P. You have financials, which are virtually flat, and then energy, which is up about 18.5% on a year-to-date basis. That is obviously the function of some surging oil prices that are now upwards of $90 a barrel. Turning to the economic front, this is unemployment week. Going to hear a lot of data. Key focus is going to be if jobs numbers are somewhat softer, does that suggest lower participation? If that is the case, the response then is companies have to pay higher wages in order to attract and sustain their employees. Obviously, higher wages translate to more sustained inflation. So something to be keeping a very close eye on. On that topic, over the weekend, we heard from Atlanta Fed president, suggested that a 50 basis point rate hike in March is not off the table. Again, it's not necessarily the base case. As they've mentioned, that will be data dependent, but clearly this is a Fed that is serious about tackling inflation. You've also seen estimates now from a lot of the big banks targeting anywhere from 5 to 7 rate hikes. Again, we have 7 Fed meetings this year. In theory, could do 25 basis points in each rate hike. But clearly, we are now in an environment where interest rates are headed up. As we all know, interest rates up, bond prices down. Fixed income has been a very challenging environment year to date, especially when you think about the equity volatility. Barclays Ag down just about 2%. Tips have sold off in anticipation or with expectations that inflation will start to revert back to historical levels at some point. Then obviously the more equity sensitive segments of the bond market, preferreds, down fairly significantly. Only safe place has been on the shorter term. And interestingly enough, although it's a very strong credit environment, high yield has lagged. The only sector, though, in the green this year. Bank loans, that is probably the largest overweight in our tactical portfolios when you think about fixed income positioning. Getting back to GDP though, got some very encouraging figures for Q4. GDP rose 6.9%. That exceeded expectations of 5.5%. And that's very encouraging, almost 3 times the 2.3% growth that we saw in the third quarter. Obviously, Q3 more directly impacted by Omicron, but very encouraging. Again, when you think of that macro backdrop, global growth is certainly slowing. A lot of that low-hanging fruit following the recession has already been harvested, but not in a below growth or below historical average year, at least based upon what we're seeing thus far. The other encouraging sign on an economic front is we saw positive real consumer spending that increased as well. With that, you saw savings rates come down. And again, the takeaway there is that suggests that the inflation is not the growth killing concern, at least for today. Longer term, certainly a separate topic, and one clearly, as we mentioned, the Fed is taking a very serious approach to. But based upon where we are today, based upon the health of the overall consumer, that has not been a major concern, at least for now. On a somewhat more cautionary note, turning to the geopolitical front, over the weekend, we saw bipartisan support for the mother of all sanctions against Russia. That was a 2-part deal. One talked about what would go live today. Secondly, what would happen, meaning what sanctions would be turned on in the event of a Russian invasion into Ukraine. Obviously, that is somewhat concerning. We also see President Biden sitting down with the leader of Qatar today, talking about being able to potentially redeploy energy into Europe. European energy, large percentage of that is created from Russia. So something, if there were those sanctions, if there was an escalation, Europe would need to solve for. Again, I don't know if that makes me any more or less comfortable with the situation that's going on in the border. Interestingly enough, though, you did see RSX, that is the Russian equity ETF. Granted, that's down 25% year to date, down about 30% off of end of last year highs. But that has actually rallied as of late. Again, mixed signals there, certainly something to keep a very close eye on, as any sort of international event could certainly put some downward pressure on risk assets. A final thing, I want to share a quote that was mentioned from Goldman Sachs chief equity strategist. Corrections rarely turn into bear markets unless the economy is headed into a recession. And then with that thinking, or understanding if that is the environment we're in, that those corrections can provide good buying opportunities. I don't know that we are here just yet, but the conversations Michael and I have on a daily basis, I think very good chance or greater probability rather for the next 5% move to be on the upside versus the down, barring any sort of major geopolitical event. So certainly look for that in the updated positioning as well. If there's anything Michael and I can do, please don't ever hesitate to ask. Have a great day, have a great week, and talk soon. Take care.